A moment for me was when I saw the Canadian regulator issue an order that allowed for an ETF with the underlying asset being Bitcoin. Not a derivative, the actual asset was Bitcoin. That to me said, okay, here we go. Because I've always considered, and this is a personal opinion, that the SEC and the OSC work in tandem, and that basically Canada is a petri dish for testing ideas. And one of the big concerns about an ETF with Bitcoin, would it have huge tracking error? Would there be issues around the volatility of the actual ETF price? And if there was a 20% correction in Bitcoin, which happens all the time, that ETF has performed flawlessly. And I think it should set up for licenses issued stateside. Same with Ethereum, same idea. And it allows retail investors to invest without having to go through the whole crypto crap. So it was a seminal moment. I said, now I got to get involved. And so it's always based on allocations, typical sovereign funds. And the reason I bring up pension sovereign, they are the investors. I mean, for all the excitement about Bitcoin, nobody owns it. I mean, it's a nothing burger asset in the context of sovereign and pension wealth. 800 billion is nothing. I know that sounds trite, but it's true. And so the way to get this asset to be a part of the real investment world is to get it regulated. Any of these assets, pick one. I personally would like to see stablecoins regulated first because it's easier to do that. But whatever happens, we need regulation, because then here's why this works. So you want to have a 1% weighting in a $100 billion fund. A fund like that would have no more than 20% in any one of the 11 sectors of the S&P and no more than 5% weighting in any one stock or bond. That is a classic diversification strategy for long sovereign wealth, where trillions and trillions of dollars live every day. And so they would like to have 1 to 3% in Bitcoin. It's the one they want to start with, the one that's the biggest opportunity, and the one that frankly the managers understand, because it's been in front of everybody since the beginning of cryptocurrencies. If we get that regulated, they'll start putting on 50 to 100 basis point weightings. And then what you'll see happen, besides increased demand, you'll see less volatility, because when you have a 1% allocation, it sells down, you buy back to 1% by market close. And of course, crypto is 24/7. So they'll buy it back up to 1%. If it exceeds, it jumps and doubles in price, they'll sell it back down. But they are the market, they are the bid forever. And everybody else benefits from the fact that the stability and the volatility is reduced dramatically, and the price will be significantly higher over time, and they could, in the context of crypto, go up to 20%. And I personally believe that crypto in the next decade will become the 12th sector of the S&P, because it is so strong a potential for reduction in fees, transparency, auditability, and just better financial services globally, that it'll make its way there. But it can't happen until somebody starts to regulate it. Now, good news, we've got the Loomis bill, we have the Haggerty bill, we've got the Toomey bill, we've got bipartisan effort. I think all three of us have been to the Hill multiple times to talk to these senators, to talk about, give us the code, regulate it, and then, when that happens, Katie, bar the doors. Watch what happens. I think it's that simple. I'm going to give you a real case study that happened last week that I think highlights why we need to get to what Jeremy's talking about. I do a lot of transactions in real estate in different geographies, and they're large transactions. And so generally what happens, you're going from one geography in US dollars to another geography in another currency. And so you have to transfer that money and to that new geography, then you have to FX it into the local currency, then buy the real estate. So last week we did and this bank is a large global bank, don't have to mention the name because the story's not nice, and we transferred millions and millions of dollars to its corresponding bank in another geography. They lost it. They lost the money for 48 hours, jeopardizing the closing of this transaction, and our team went out of their minds, including the Fed number, and they found it about 12 hours before the transaction was supposed to close, and they said, it was a back office error. They owe us a lot for what happened. Yeah. I spent, even before the wire went, 18 minutes listening to a clerk read disclosure statements to me, which is a complete waste of both of our time. And I realized this is insane. This is before they lost it. And then we spent about 35 hours of staff time trying to find the money in their system. So, and I actually called one of the board members of the bank and said, have you ever heard of USDC? Have you ever heard of a stable coin? Do you know how it works? And have you done any work to try and figure out, because this is commonplace, this happens all the time. It happens with smaller amounts, but when it's a transaction this size, they owe me interest for 48 hours on millions of dollars, and we're going to fight about that too, and some kind of penalty I should impose to maintain our relationship after what they did. But the point is, that board member doesn't know anything about this. And those bankers got to get hip to this stuff because they're going to get smoked if they don't provide service at some point. What I'm hoping from policymakers is to pick one thing and solve for that, then pick another thing, because crypto is so broad and diverse, and there's so many assets, and there's so much debate. You know, an NFT is, with utility, is that a security, is that a commodity, all those kind of things. Here's what I'd like to see happen, because for me the use case is so powerful, and it would also support the idea of maintaining the US dollar as a reserve currency globally. I'd like to, and I've read both bills, so I'm just giving you Cole's notes on what the Toomey bill and the Haggerty bill say about stable coins. Not just USDC, all stable coins. It's very simple. The Haggerty bill is 2 pages. Every senator can read 2 pages. And so the point is, they're asking for an audit every 30 days. What's wrong with that? Nothing. In fact, that would make you feel more confident about the asset. And secondly, they would like to have no underlying asset have a duration of longer than 12 months. No problem with that. And pass that one thing. Make that law for all stablecoins. Now, what would happen is, we all know that not all stablecoins are created equally, and if you're not willing to be exposed to an audit, then I certainly don't want to use you. You could still maybe go in a rogue environment, but I think that would immediately take, and in passing this bill, the regulator could say, we're going to license 10 stablecoins or 5 stablecoins and let them have little different attributes, just like a fund at Fidelity is a little different than Schwab or whatever, that's fine. But I don't want to see the government writing code. That's not what they're good at. Yeah. Let the private sector innovate with the legislation and let these stable coins flourish backed by the US dollar. 100%. Why wouldn't we all want that? I mean, that makes a total amount of sense, and I wouldn't be getting screwed on my real estate transactions. That's why I want it. There's a lot of merit in picking one thing and forcing that through policy. And I think it's an easy use case. Everybody understands the value of a stablecoin. It's not as speculative. Its value after being audited certainly wouldn't vary that much. It would be the one thing. Now, we're not going to get any policy till the midterms are over, but that's not that far away. Then I think this bipartisan effort that Jeremy's talking about could get the one thing. Let's get one thing done. This sounds like one of those speeches back in the Apple days. One more thing. Remember that?
Yeah.
It's the same thing here. To me, DeFi should be defined as both centralized wallets and decentralized. It will be complementary. It will help these banks do their jobs better. It will create more competition. Fees will go down, more transparency, and definitely the ability to transfer capital between institutions much faster and efficiently. And it will squeeze out middlemen all over the place, particularly in FX trading, where they are savages and add no value, and I can't wait to put them out of business.